Welcome back to Smart Stock Sam, and today we're diving into something absolutely explosive. We're talking about DataVault AI, a stock that might be sitting at its absolute last dip before a potential short squeeze that could send it parabolic. Is this penny stock actually a disguised fundamental powerhouse? Could those 65 million trapped shorts be forced to cover any day now? Stick around because by the end of this video, you'll understand why this might be one of the most mispriced opportunities in the AI sector right now. What if the market is completely blind to one of the most aggressive pivots happening in AI today? Right now, DataVault presents a classic coiled spring setup where explosive fundamental growth is screaming by. But technical indicators show total market chaos. It's an all-out war between what this company is actually building and the temporary panic on the trading floor. But here's the thing, this spring is wound so tight, it's only a matter of time before something gives. Let me show you the asymmetry that makes this so compelling. On one side, you've got management signaling a 10 times revenue explosion for 2025, protected by a massive $128 million cash fortress. On the other side, the stock is being crushed like a distressed penny stock because over 65 million shares have been shorted into the ground. This is the ultimate clash between backward-looking fear and forward-looking growth potential. The question is, which force wins? Now, a 10 times revenue jump sounds like pure fantasy, unless you understand the seismic shift happening inside this company. DataVault isn't some startup chasing a dream. They're pivoting from a proven hardware legacy in wireless audio into a national-scale Web3-powered AI infrastructure. The legacy business gives them operational credibility and baseline revenue, while their new edge compute model positions data storage exactly where it's generated. This is strategic evolution into the future of data monetization, not vaporware hype. And when you transition from selling low-margin hardware to licensing high-margin AI software, the financial trajectory stops being a line and becomes a rocket ship. We're sitting right at the inflection point of a massive J-curve. In 2024, revenue was a modest $2.7 million from hardware sales. By 2026, they're targeting $200 million as they shift into platform monetization. They've already locked in a $150 million strategic investment, and they're sitting on a $49 million licensing backlog just waiting to convert. The math here is staggering. But growth projections are just numbers on a presentation until you see who's actually writing the checks. This is where the meme stock narrative completely dies and institutional reality takes over. DataVault has secured a multi-year IP licensing agreement with NYIAX built directly on Nasdaq's financial framework. They've partnered with IBM for edge AI deployments and established a research center in Taiwan, targeting a $2.5 billion market opportunity. These aren't handshake deals or LOIs. This is contracted backlog with billion-dollar institutions. While those fundamentals look incredible, there's one technical setup brewing beneath the surface that could accelerate everything. The market microstructure here is absolutely wild. Nearly half of all trading activity, over 43%, is happening in dark pools, completely masking real buy-side pressure. Different reporting agencies show short interest anywhere from 12 to over 20% of the float. That 65.4 million share short position isn't just big, it's a ticking time bomb in a market with razor-thin liquidity. And that bomb becomes even more explosive when you realize the shorts are completely trapped. Look at the liquidity crunch. The cost to borrow DataVault shares has rocketed from 8.7% to 15.7% in just weeks. We're seeing a massive cluster of fails to deliver right at the $1.40 mark. This means shorts who entered at 1.40 are technically in the money, but they're trapped by a complete liquidity drought. Any sudden buying pressure forces them to cover into a market that literally has no shares available. What happens when they all rush for the exit at once? So if everything looks this bullish, why is the stock still trading at 77 cents? It comes down to one temporary factor: institutional fear. There's been a waterfall liquidation because a major holder, Silex, recently dumped 31.2 million shares onto the market. That created a massive technical sell-off, but it has absolutely nothing to do with the company's actual health. DataVault's debt-to-equity ratio is a rock-bottom 0.14, and their cash runway extends 4 years into the future. Analysts are currently targeting $4 per share. That's over 400% upside from today's price. Are we really supposed to believe the fundamentals are worth 77 cents? We don't have to wait years for this thesis to play out, because the catalyst pipeline is already loaded. In the coming weeks, we have a sentiment catalyst with the Dreambowl token distribution that could reignite retail interest. Then there's the revenue catalyst, as that $49 million backlog gets verified and converted into reportable revenue. By mid-2026, the Taiwan Research Center launch and the FinTech TV pilot could force the market to finally wake up and recognize the new reality DataVault has built. When you break down the numbers, there are really only 2 ways this plays out. Scenario A is the short squeeze. A spike in Bitcoin prices or a successful token drop forces those 65 million shorts to cover, gapping the stock straight past $1.50 in a violent move higher. Scenario B is the fundamental D-risk. Steady revenue validation leads to gradual institutional accumulation, driving a methodical climb toward that same $1.50 target. Either path gets us to the same destination, but the current 77-cent price looks like a massive temporary dislocation. From a technical perspective, we're testing absolute support right now. The support zone sits between 67 cents and 90 cents, and we're right in the middle of it. The big breakout target is that 1.40 to 1.50 range, where all those trapped shorts are sitting underwater. We're watching a pure tug-of-war between technical selling pressure from that institutional liquidation and undeniable fundamental buying support from the cash position and backlog. So after dissecting the hyper-growth trajectory, the trapped short position, and the massive cash fortress, what's the final call? This is a speculative buy opportunity. You're looking at a fundamental powerhouse being temporarily disguised as a distressed penny stock. You've got a $128 million runway protecting your downside and 65 million trapped shorts providing rocket fuel for the upside. Once this institutional selling wave finally exhausts itself, the recovery from 77 cents could be violent and immediate. This is the textbook definition of a coiled spring about to release. Now, before we wrap up, a friendly reminder like always, this video is for educational and information purposes only and should not be considered financial advice. I am not a licensed financial advisor. All investments carry risk, including the potential loss of principal. DataVault AI is a speculative penny stock with high volatility. Always conduct your own due diligence, consider your risk tolerance, and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. If you found this analysis valuable, smash that like button and subscribe to Smart Stock Sam for more deep dives into explosive stock opportunities. Drop a comment below and let me know. Are you watching DataVault AI for the squeeze, the fundamentals, or both? I'll see you in the next one.